All right, let's talk about the wild swings of the crypto market. It can feel like pure chaos, right? But what if we looked at it like a machine? Something with predictable parts that we can actually start to understand. Let's get into it.
I mean, we've all seen it. One minute, it feels like everyone's a genius printing money, and the next, it feels like the entire world is crashing down. If you've ever gotten whiplash just trying to keep up, you are definitely not alone. So what is really going on here?
Well, here's the good news. It's not just random. Those huge market moves are actually driven by a powerful combination of three core engines. And once you see how they work together, the whole cycle starts to make a whole lot more sense. So, engine number one is liquidity. The easiest way to think about this, it's the fuel for the entire crypto market. It's all about how much money is out there, and more importantly, how easily that money can flow into riskier things, like crypto. The more fuel in the tank, the bigger the potential moves.
And what controls that flow of fuel? Well, it's usually stuff you hear about on the news all the time. When interest rates are low, people are more willing to spend and invest. A weaker dollar can make assets like Bitcoin look more attractive. And a growing supply of stablecoins, that's like cash sitting on the sidelines, what people call dry powder, just waiting to jump into the market. This is the big picture stuff that really sets the stage.
But, all that fuel needs somewhere to go. It needs direction. And that's where our second engine, narratives, comes into play. Think of these as giant magnets. They're simple, powerful stories that pull all that money and all that attention toward a specific coin or even a whole sector.
And you've seen these narratives everywhere, right? The idea that Bitcoin is digital gold. That's a super powerful story about storing value. The launch of ETFs tells the story of institutional adoption. And more recently, you've seen narratives around AI tokens or meme coins pull in billions of dollars. These stories are how the market focuses all that capital.
Okay, our final engine is psychology. And if liquidity is the fuel and narratives are the magnet, then psychology is the accelerator. It takes everything else and just floors it. We're talking about raw human emotions, greed, fear, and that intense fear of missing out, or FOMO. It amplifies every single move, turning little ripples into massive waves.
And in crypto, oh man, psychology is just supercharged for a few key reasons. For one, the market never, ever closes. There's no time to cool off. It's also incredibly driven by social media hype. And the easy access to leverage lets people make these huge bets, which creates absolutely violent price swings when things go wrong. So when you get those three engines running at full tilt, a pretty predictable pattern starts to emerge. It begins with accumulation. That's the quiet phase when almost no one is paying attention. Then comes disbelief, as prices start to creep up, followed by wider participation. That builds into full-blown euphoria, right before the smart money starts to head for the exits during distribution. And that, of course, leads to a downtrend fueled by fear, and then the whole cycle gets ready to start all over again.
It's really an emotional roller coaster when you lay it out like this. During that accumulation phase, it's all boredom and fear. Good news barely even registers. But then you flip to the euphoria phase, and suddenly, everyone thinks it's easy money. Every single tweet can move the market, and it's just pure greed and FOMO. And this, unfortunately, is where most new people decide to jump in.
A lot of times, there's one single, massive narrative that acts like the spark plug, the thing that gets the whole machine revving. And in the world of crypto, one of the most powerful and well-known narratives has always been the Bitcoin halving.
So what is it exactly? Well, to put it simply, the miners who secure the Bitcoin network, they get rewarded with new Bitcoin. And every 4 years or so, that reward gets cut in half. That means the creation of new Bitcoin literally slows down. It's a programmed reduction in new supply baked right into the code.
Now, this is so important. You have to understand what the halving does and what it doesn't do. Yes, it absolutely slows down the flow of new supply. And yes, it creates a very powerful story about scarcity. But what it does not do is guarantee an immediate price pump. It can't just magically override a bad global economy, and it's not some magic button for all the other coins. It's a fundamental change and a narrative event, not a price guarantee.
Okay, so now we have the map, we understand the cycle, but knowing the map is one thing. Actually navigating it without letting your own psychology crash the car, well, that's the really hard part. This is where most people get into a ton of trouble. Trap number one, FOMO. We have all been there. You see a chart that's just gone completely vertical, your friends are all bragging about their gains, and you feel this intense, overwhelming pressure to buy right now before it goes even higher. That is your psychology screaming at you to just throw logic out the window.
So how do you fight it? The only real antidote to FOMO is having a plan before it happens.
A simple rule: just don't buy a chart that looks like a giant green skyscraper. And remember, seriously, if you missed a move, you missed it. It's okay. The market will always give you another chance.
Now, the second trap usually comes right after the first one. Let's say you FOMO in, the price immediately drops, and you take a loss. Now you're angry. Revenge trading is when you try to win it all back fast by making even bigger, even riskier bets. It's basically like trying to put out a fire with a can of gasoline.
The prevention here is pure discipline. After a really painful loss, the smartest thing you can do is usually the hardest. Cut your position size way down or just step away from the screen for a while. Because if you're angry or frustrated, you have lost all objectivity. At that point, your brain isn't your friend anymore. It's your enemy.
And that brings us to the last and maybe most dangerous trap, especially when things are going great: overconfidence. This is the classic bull market disease. When every single trade you make is a winner, it is so easy to start thinking you're a genius and to confuse skill with just being in a market where a monkey throwing darts could make money.
To fight this, you have to stay humble. You have to assume the market can and will humble you at any moment. Keep your strategy and your risk management consistent. In fact, when things feel the most euphoric, when it feels easy, that is precisely the time you should be thinking about taking risk off the table, not piling more on.
So, with all this chaos and noise flying around, how do you stay objective? It really helps to have a filter. Before you react to some crazy headline, just ask yourself these questions. Does this news actually change anything fundamental about access to money, about demand, supply, or risk, or is it just chatter? This little checklist can help you separate the real signals from all the deafening noise.
If you take only one thing away from all of this, let it be this: the vast majority of these explosive, face-melting rallies in crypto are not because a project suddenly became 10 times more valuable overnight. They are a function of liquidity, that fuel pouring into a powerful story and then being amplified by human psychology.
So in the end, you can think of the crypto cycle as a game. The market is the board. And the rules? Well, they're driven by liquidity, narratives, and psychology. The market is absolutely going to continue to swing from fear to greed and all the way back again. But now you know the rules. So the only question left is, how are you going to play?